Hey everyone, Couch Investor back on our earnings video for today. So Hims and Hers, ticker symbol HIMS, has just reported that Q3 earnings report and a pretty good one as well. Now there are some things that we need to touch on. Unfortunately, the presentation is still not out yet. Usually they give us a bit more information about certain products, markets, stuff like that. So that's not out yet. So I'll do an update video whenever I can. And yes, the video about Mercado Libre is going to come out. I just have been very busy lately. But first big announcement with this report is that they announced a $50 million share repurchase program. So they say here, given the growth strength of our financial profile and strong cash flow position, we are excited to announce we are implementing a share repurchase program to take advantage of an attractive opportunity and return value to shareholders. While we've seen substantial volatility in the capital markets impact our share price in the short term, the new repurchase program reflects our deep confidence in the intrinsic value of our business. This is this is a good indication of them basically saying we think we are worth more than what the market is telling you. Now again, that said, doesn't mean that they're going to buy right now $50 million worth of their shares. It's not a big buyback program, by the way. We've seen $1 billion buyback. This is just 50 million because, well, this company still isn't printing that much money and they still need money to invest in their business. You're going to see why. And now before we jump into this report, just an FYI, this was from Emergent Research. They expect the whole telehealth market to grow 24.2% at a CAGR of 24.2% from 2019 to 2032, which would mean that that market would be valued at around $450 billion. I believe last year, that market was valued at $83.43 billion. So yeah, it's going to be a very big market. Of course, HIMS is not like Teladoc, for example, but still the whole telehealth market, HIMS does play a particular role in that industry. And hey, even if they just take a small fraction of that $450 billion, that would be extremely lucrative for the business and of course will create a lot of shareholder value. Now, before we jump into this earnings report, if you enjoy this type of video, leave it a thumbs up, subscribe if you have not. On Tuesday after the market close, we're going to have a live stream on the channel with Arnie and Alejandro. We're going to talk about Robinhood, the report and the earnings score, so stay tuned for that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so let's have a look at the numbers here. Revenue increased 57% year over year to $226.7 million. By the way, this was a triple beat as well. Net loss of $7.6 million, adjusted EBITDA profitability of $12.3 million. Subscribers grew to 1.4 million, that's up 56% year over year, and they exited Q3 with over 80% of orders fulfilled via affiliate facilities. Now, they're also raising full-year guidance to the range of $868 to $873 million and adjusted EBITDA guidance to a range of $43 to $46 million. Again, if you have a triple beat, that means that you are pretty confident in what you're doing with your business. And so, a couple of comments here from the CEO and CFO. I'm proud of the progress made across several of our key pillars in the third quarter, which meaningfully moved Hims and Hers one step closer towards our vision of an accessible, personalized platform. Personalization continues to gain traction across our platform, and the anticipated completion of our migration towards affiliated facilities by year-end will further strengthen our ability to provide customers with a broader set of personalized solutions, providing us with a strong conviction that this will be a differentiator over both the near and long term. They're talking here about MedMatch, our AI-based service that leverages anonymized data across Hims and Hers' expansive data set, has the potential to aid providers in their ability to efficiently select the right personalized solutions for each individual consumer. With all of this great progress, we believe the end result will be more customers that are happier and healthier on the Hims and Hers platform. This is going to be a very crucial part of the long-term thesis if you're a long-term investor here, being able to offer personalized solutions to your customers. Because if that's the case, then yes, that customer will more likely than not stay with you for a long period of time. As for the CFO, he said our continued execution of providing a platform that offers an increasingly broader set of personalized solutions to customers while also achieving a level of operational efficiency that we believe few in the market are able to match, uniquely positions us to offer personalized solutions to customers at a mass market prices and drive more value to customers. We have strong conviction that this has and will continue to enable us to drive greater market share and also concurrently expand margins. And so, subscribers, as we've seen before, that increased 56% year over year. The monthly online revenue per average subscriber, that's actually down 4% year over year. Net orders is up 33%. AOV average order value is up 19%. As for online revenue, of course, that increased more than wholesale. That's up 57%. Wholesale is up 39%. And so overall, we're up 57% year over year. Gross margin was 83% for the third quarter compared to 79% same quarter last year. Then, as for the fourth quarter, they expect revenue of $243 to $248 million with adjusted EBITDA of between $14 to $17 million, representing an adjusted EBITDA margin of 6 to 7%. As for the full year, they now expect adjusted EBITDA margin of approximately 5%, previously was between 4 and 5%. Now, if we scroll all the way down here, you can see revenue, cost of revenue, total operating expenses. Now, while revenue increased, 57% or so year over year, operating expenses increased approximately 45% or so. So yes, again, there is that same trend line. Revenue goes up, but so does all operating expenses. So keep that in mind. If we suddenly see total operating expenses decrease, but revenue can continue to increase, that's great. But if expenses decrease and so does revenue growth, then yes, the thesis of, the short seller thesis that they have to keep on spending to attract more and more users, more subscribers to increase that revenue. Keep that in mind. And as for total stock-based expense, that has actually increased 57% year over year. Now, last thing I want to show you before looking at the graph, this is coming from the Q2 presentation, obviously, but this is just showing you that, there's still a long way to go for this company. They said here, we continue to unlock growth in our immediate markets and are primed to capture future unpenetrated opportunities, whether it's weight, pain management, fertility, you name it. I mean, there are plenty of markets for them to still enter. They just enter cardio. They're going to enter the weight one, and that's a pretty big one. So yeah, there's still a long runway for this company. Now the question is, can they continue to grow, and can they continue to grow in a more profitable way as well? Currently, they're doing everything that they have to. Margins are becoming better and better as well. So yeah, I mean, so far, so good. And now looking at the graph, currently the stock is up anywhere between 3 to 5% or so. We're back at $6.69. So that means that if the market were to open right now, that candle here would be green again. We're over the 20 and the 50-day moving average. RSI is pretty low, but nowhere near being oversold. Again, I think 720 is going to be a resistance point. Remains to be seen what gets set throughout the earnings call. But again, this report was a good one. Guidance was good as well. And now it's just a matter of a waiting game. Can they continue to execute the way that they've been doing that? And if the market doesn't appreciate it, now they have $50 million to buy back their own shares. So overall, pretty good report. I like what I'm seeing. Yes, expenses are still going up quite a lot, and so does SBC, but currently the market is justifying that by growing the business fast as well. So do share your thoughts down in the comments below. That will be it for this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.